Okay, welcome everybody. And for those folks watching the recording as well, welcome. We are Carmichael Hill, the investment advisors on the Chevy Chase Acura 401k plan. And so with this invite, there should have been an agenda or a memorandum that has the reports that we're going to go through. And so if you haven't gotten that, I would ask Sam or Brenda to send it out to you. We will be walking through that on the screen. So if you don't have one in front of you, that's fine for this time. But in the future, if you want to look back at it or you want to take the risk tolerance questionnaire test or whatever, you might want a paper copy as well. So you might want to be able to print it out. But thanks for having us. I'm Jim Stewart from Carmichael Hill, and Morgan Tester is also an advisor here at Carmichael Hill. We're both CFPs, and we're going to do the participant education meeting. In addition to just going through the overall of the plan and retirement plan benefits, we're also going to talk about two fund line changes. We're going to change the two funds out of the current plan and add new ones into the plan, if I can speak right. Those will be sent out an announcement to you in the coming weeks. Those changes probably won't take place until December, but there are two funds that we are swapping out for two other funds, and we'll get into the particulars with that. But if there's two things I want to kind of get across today in the whole meeting, it's these two things. One, the markets have had a great run over the last 2 years. Really since the pandemic started, that was kind of like the low, and then Congress threw a lot of money at the markets and the economy and the Fed as well by lowering interest rates. And that has caused the stock markets to go up dramatically. Also has caused some inflationary pressures, which you've probably seen in food and housing and different things now as well, to try to get the economy back started again. And so the market's done great. So one, I want you to check your allocation to see if it should be rebalanced, because it's possible that you're overweight equities and underweight bonds or fixed income. Conversely, if you are new to the plan and you were just put into the plan into the qualified default investment option, you might be in the stable value fund, which is like a cash reserve. It has a 2% yield, which is pretty good compared to regular money markets, but it's still a really low yield. And if you're young, that might not be the best place to be. So I think that you should have just received your statement, your quarterly statement from BPA in the last week or two. And so you should review that to check your allocation, because you might need to rebalance it. You might need to go more into equities or less. Okay. So that's the first thing I want you to take away from this meeting. The second thing is that you should try to increase your savings rate if you can. Every year that you build reserves for retirement, it makes it so much easier once you're actually in retirement. And the number of years you're away from it, it allows the money to compound. And so you really want to take the benefits of that plus the match that the company offers to let those assets grow so that you can have a good benefit into retirement. And the younger you are, the better it is. And the reason why that is because the funds will grow during those years. And the closer you are, it provides a limited amount of time for that to happen. So just for an example, if you're in your 20s and you plan to work probably 30, 40 years until retirement, your funds could actually roll or double about 4 times during that time frame. And so if you put in, say, $10,000 now, it would go from 10,000 to 20,000. That's one roll, then 20 to 40, 40 to 80, and then 80 to 160. So that 10,000 could be 160 in retirement. And if you do that for every year, those things add up at the end. And of course, the company matches 10% of the first 15% of pay. So it's, you add that to the amount that you contribute, and what you contributed is pre-tax, so it's not taxable to you. So example, if you use that 10,000, the 10,000, and you're in a 30% bracket between state and Fed taxes, you get a $3,000 deduction off of your taxes, and so it's only really costing you $7 for that 10,000 that's in there, and then the company's matching you $1,000 on that 10% of that 10,000. So you're really getting 11,000 for a $7,000 investment right off the bat. And so I think that is a great way to kind of look at it. And if you can do that when you're younger, I realize when you're younger, you also have other priorities, families, houses, just getting started, student loans. You could have all these types of things that are pulling on the daily budget. But if you can afford to put a little bit in, then and let it grow and double during those time frames, then it can be a considerable amount when you go to retire. Okay, so those are the two takeaways. One, rebalance. Look at your allocation. Just make sure that it's where it should be, so that it fits for your current risk tolerance and what your goals are. And then two, increase your savings rate if you can. Sometimes when you get a pay raise, that's usually a good time to do it, because you can automatically just kind of increase your savings into the 401k, and you don't even feel it on your daily budget, because it hasn't really changed. It's just you're taking the increase, the raise, and saving it. Now, I will say a couple things about that. It is saving for retirement, so it's not really for a year investment or a 2-year investment. When you put the funds in there, you really want them to stay in there, because there are penalties and taxes and stuff if you withdraw the funds. If you do get into a pinch, there are loans that you can take from the 401k, and those parameters are 50,000 or 50% of the vested balance, whichever is lower. And you can take out a loan. It could be for 5 years, a little longer if you use it to buy a house. But then you're using after-tax money to pay that off, and it's really not a great way to go about it. So there are usually other alternatives that are cheaper and better than accessing the 401k through that. There are also hardship withdrawals if you need to have the funds, and it's like the method of last resort. Like there are no other options for you. You could access it at that point. But by and large, the money you put in here should be for retirement. Okay, and that also means that maybe it should be allocated towards more equities, because you can take a little bit more risk, because it's going to be in there for perhaps decades, depending on what your age is. A couple other things I wanted to just mention regarding the beneficiaries. If your life situation has changed, in other words, you got married or you got divorced or you had kids, and you want to update your beneficiaries, you should do that through Brenda, because sometimes it's an easy thing to overlook. You think that you don't need to update those beneficiaries, but if something happens to you, you want to make sure that your funds are going to who you want them to go to. The beneficiaries on the 401k supersede your will. So if you do have a written will that has everything going to your kids or to your current wife or whoever, your brother or sister, whoever, if that happens, you have a will that says that, and the 401k beneficiary says something different, the 401k beneficiary supersedes what that will says. So it's important to, when you're doing kind of an annual checkup, to make sure the beneficiary is who you want it to be. Okay. All right. So at this point, does anybody have any questions on any of that I just talked about? One more thing I want to just mention is the contribution limits. You can put 19,500 into the 401k this year. And if you're over the age of 50, you can do another 6,500. So that makes it 26,000 if you're age 50 or older. Okay. Does anybody have any questions on any of that I just talked about, between the match, the contribution limits, beneficiaries? Okay. All right. So we'll just move on to the handout that we had there. So Morgan, do you want to share the screen, and then we can start going through that?
Okay, so can everybody see this?
Yes.
All right. Jim, did you want to go over this portion, or do we want to?
Go through it.
Yeah.
Okay, so this handout, it's about 13 pages long. The first part here is just going through what the packet is about. It has to do with research options on your funds that are available in your plan. They're all really good funds, in my opinion. The Vanguard funds are low cost. They have great performance, and that makes up a big chunk of them. There is a difference between several different types of the funds. Some of them are passive index funds. In other words, they're very low cost, but they're based off an index. And then others are actively managed by a portfolio manager that selects the investments inside there. So some of the funds that are actively managed, they usually have a little higher expense ratio. The ones that are passive, that are just based off an index, they're usually lower cost because there's not much overhead as far as research and different things you have to pay for. So the actively managed ones try to outperform the indexes, but that doesn't always happen. Actually, most of the time it does not happen. About 80% of the time, the index outperforms the portfolio manager, mostly due to the performance drag of their management fees and other dynamics of like holding cash and different things in the portfolio and trading cost. So when we look at the funds, we'll show which ones are active and which ones are passive. But by and large, you have a collection of investments in here that we think are very good choices to make a diversified portfolio for your retirement. Okay. Other things in here is a risk tolerance questionnaire. When we talk about allocation, that's the percent of your overall assets that are between stocks, bonds, and cash. Cash in this account is called a stable value fund. But when we talk about the allocation, the overall allocation, we're not only talking about the 401k account, we're talking about all of your investments. So it might be your spouse's assets as well. It might be that you have an outside IRA from a previous employer or previous 401k account, or you might have an inheritance. So you might have several different accounts, and we're talking about the overall allocation for all of them together. And that's what this model, this little worksheet questionnaire kind of walks you through to what it should be. So if you're holding a lot of assets in the bank in CDs or treasuries, well, maybe you should be more aggressive in your 401k plan. Conversely, if you were or your spouse works at a company where they get stocks, or they have a lot of equity investments, and you have a lot of Microsoft stock or Google or Alphabet or something, and you have a lot of stock outside, well, maybe you should be more conservative in the 401k account. So it just depends on what your situation is. Everybody's situation is a little different, but this questionnaire kind of gives you a good overview of what your overall allocation should be based off your risk tolerance. Okay. You can change your allocation inside that plan at any time. You could do it, every other day if you wanted to. We don't definitely recommend that, but we think that, looking at your quarterly reports that you get, that's a good time to look at it and, decide whether you should rebalance or not. Okay. We're here to help. BPA, who is the custodian and the third-party administrator, they provide a lot of tools on their website. And we're going to go through some of those tools in just a little bit, so you can kind of do a little research or whatever. But also, Carmichael Hill is available. We're available via our contact information is on the page there. You can email us, you can call us. We can see your account. If you give us your name, we can log in and see what your account is. We cannot make any changes to it though, but we can see how it's allocated. And if you want to talk through what you have outside and want to pick our brains a little bit, we're here to help. And we can do that via a Zoom thing like this, or by email or by phone. So feel free to reach out to Morgan or myself, and we'll be happy to kind of walk you through. We'll ask you some questions, we'll see what you have, and then we can give you some pointers about what we would do. Now, at the end of the day, though, you do have to make the changes. So we cannot make the changes for you. We can only see kind of how it's allocated currently. So we can see a snapshot of it, but we cannot actually make the changes to it. Okay, Morgan, you want to scroll to the next one then and take over?
Yeah, so this is just the contact information for everybody who is involved with your 401k. So for any mutual fund investment choices, you need to walk through and talk through your allocation possibly. You know, we're here to help. There's our phone number there. For account operations, that's your beneficiary change, your contribution changes, you're gonna contact Brenda. And then if you have additional questions, this is more so maybe what to do with on the site. You're going to want to go for Brenda first and foremost for any changes, but if you have some more site questions, then you can go to Andrea. And then we have your login website for your online access to your account. You're going to click on the participant accounts, and that's where you're going to go ahead and log in. And if you need your account balances, if you don't want to log in, you want to call someone, talk to someone, that phone number there is for your account balances and adjustments that you want to make by phone. We have already, you can click option 1, don't have to go through the whole list of it. And if you are new to the plan, the initial PINs to log into your account were sent to you via mail. If you no longer have that, or maybe it's expired, you can always request that PIN be sent to you again by calling that 1-800 number. And then next. This is another option that BPAS offers to you. So you can always log in through desktop, but they do have a mobile app. So this is nice to just be able to look at it on the go whenever you would like. They have a get started on a walkthrough for it. You're going to download BPAS Retire. That's the mobile app. You're going to register it on the app, but you do have to log in to your desktop or laptop to just make sure register that device, and you'll be able to use the app going forward. You won't have to do that again. And they are secure and do use a 2-factor authentication. So it is a nice way if you're not really into looking at your account online, you can just do it on your phone. And then this is the resources we were talking about that BPAS offers to you as participants. So I'm going to walk through on each one. That top one, the account breakdown, and this is on your homepage. Like this is exactly what you're going to see when you log in and you're on your homepage. It's going to be at the bottom half of it. So you have your account breakdown. So it's going to say how much you have in each of the funds that are available to you. It'll break it down in percentage and dollar wise. And then your balance history chart, that's going to show you on a month-to-month basis on how much your account has grown over however long you've had the account. And there's a graph version of that as well. And then that rate of return button, that's going to show you your rate of return, and you can choose, last month, last quarter, year to date, or you can make a specific range. Like if you want to see how much your rate of return has been since you've had the account, you can make those adjustments. It's going to take, what your contributions and withdrawals are, what the growth of the account is, and any fees that were on there. It's going to calculate your personalized rate of return over that specific amount of time. And then the BPAS University button, that one is really good for all your education needs. So it's going to have information on, retirement videos and Social Security videos. So if you want to know, when should I file for Social Security, or am I eligible, and what is the eligibility requirements for Social Security, they're going to have videos and articles on that. They're also for retirement, how much can I defer? If I defer, how does that affect my paycheck? They have those type of worksheets on there also. They also have and this is also on your homepage above here, but it's also on BPAS University. You can see where I'm tracking in my retirement. So you'll put in, I'm spending this much, I'm looking to spend this much in retirement, I'm going to get this much from Social Security, and it will show you, okay, am I on the right track for my retirement, or I'm not on the right track, maybe I need to save more into my 401k each paycheck. They'll give you kind of that mile marker on there, and also will give you worksheets on how to organize your finances and stuff like that. So that's a really good resource to use other than us. There's tons of videos, tons of articles. Would greatly recommend that. And then that calculators button is also on BPAS University, but they made a specific button for it. That is calculators you can use to just see and input numbers for, am I saving enough? How much can I save? What will Social Security maybe look like, down the line? It's a ton of different calculators that you can use to kind of model out your retirement and if you are on track for it. and also will help with, what is my investments doing for me. And then that fund research button, that is where you're going to find all the information for all the funds available to you. So you're going to find the expense ratio, you're going to find the ticker symbols on there, you're going to find the performance, 1 year, 3 year, 5 year, 10 years, you're going to find all that on there, and just be able to research each fund so you can figure out which fund you think will be best for you. And then lastly, that market dashboard, that's where you can put in any ticker symbols, which is specifically for, stocks and bonds. And it can be ones that the funds that are available for you, or if you want to search up, Apple and Microsoft, you can also search up in there. You just put in their ticker symbol or you type in their company name, and you can find all the information on them, their price charts, their news, they have a whole list for that, and just their financials. So if you're just interested in learning more about it, that is available for you. All right. Okay, so this is the investor profile questionnaire that Jim mentioned earlier. So this is going to help you get a starting place on what your allocation should be for your 401k and your overall financial picture. So this is just 7 questions, very easy to do, but it takes your time horizon, which is how long is it until I'm going to have to start taking these funds, and also takes your risk tolerances. And that is, how do I feel about the fluctuations in the markets, and how much, can I stomach those fluctuations? And it combines those 2 scores, and it gives you a, model portfolio that you could use. And that model portfolio corresponds with the funds that are available in your 401k. So just to walk through that, this is the questionnaire. Again, super short, very easy. The first 2 questions are based on your time horizon. So when do I plan to start withdrawing the money, and how long does my account need to last for me? You'll combine those 2 numbers that you get from that, and you'll get your time horizon score. And then your next one will be risk tolerance, number 3. So that will be based on, okay, how knowledgeable you are about investments. And the next question is, how much financial risk are you willing to take for your financial return? So I'm fine with average financial risk for average returns, or I'm fine with high financial risk for higher returns. You can't have, low risk for high returns. You can't have that. So you have to choose, what can you stomach more often? And then next question is the investments that you currently own or have owned. It's just getting a gauge on what you are comfortable with and what you have used. So like, the lowest way is, I've only owned bonds. I'm only comfortable with bonds, going all the way up to, all right, I've owned international, which is a much more risky version of securities. I've owned international securities and international funds. So I'm a little bit more risk tolerant. And then it gives you a scenario to consider. So it says, if I've lost 25% in one stock over the past 3 months, which is a big drop, how would I react to that? So you can either sell everything, sell some, do nothing, or you're going to say, oh, this is a low price, I'm going to buy more. And so that will kind of gauge what your level of risk is, just because if you are selling in a down market, you probably shouldn't be holding as many equities because you can't stomach that downward turn. And then lastly, they give you a chart. So they say, here are these 5 plans, and it gives you an average return, but then it also gives you the best case and the worst case. And it says which one is an ideal or acceptable range for you. So let's say plan C, I'm cool with 5.6%. That sounds pretty good. I really like 27% upside and 16% I can stomach. 6% sounds better for average return, but I don't want to have more than a 20% downside. So just look at each one, just say the best case always feels good, but the worst case I'm going to say is going to feel worse. So definitely look the worst case, say how much can I stomach, and that will be more corresponding with your risk tolerance. And then for 3 through 7, you're going to go ahead and add those scores together. And you're going to go to this next page. And this is going to determine your investor profile. So you take the top is your risk tolerance score, your time horizons on the left, you meet in the middle, and that will get you to your investor profile, which will correspond with your allocation. So let's say, for example, I get moderately aggressive, so I'm in that range. So I go to the next page and I go look at the moderately aggressive portfolio, which is the second from the right. So I'm going to, these are estimates. average annual return is going to be about 10%. My best year may be 34%. My worst year may be 29%. That's okay with me. They say I'm good for a long-term investor who wants good growth potential, and I don't need any current income. It entails a fair amount of volatility, but it's not as much as a portfolio that is invested exclusively in equities. So it's going to have me 45% in large cap. It's going to have me 15% in small cap, 20% in international, 15% in fixed income, and 5% in cash investments. So when I go and look at my fund choices for you, the cash is at stable value. You have two choices for your fixed income, so you could choose one of those. Large cap, it's like Fidelity Blue Chip Growth that you have. You have two other choices, and you can just say, okay, for each section, I can choose one of these three. Again, you want to look at your outside funds and see how that corresponds, because if you have an outside 401k that is strictly invested in equities, you're going to want to adjust this maybe to be more fixed income focused. So again, look at the total picture, but this is a nice guideline to use. And if you say, oh, I got moderately aggressive, but I don't want to, have 20% in international, I don't like international as much, well, then you can always add that, to large cap. So adjustments can be made to this, but it's just a good starting point. Does anybody have any questions on this investor profile questionnaire or the resources available to you on your BPAS site? All right.
Okay, so the next choices after this are breakdown of each of the fund selections with a little description behind each one of them. And the main categories are there: the cash, the stable value fund, and then the fixed income choices that Morgan discussed, and then large cap. Scrolling to the next page gets you the small cap and the international investments as well. And then there's one hybrid choice, which is the Vanguard Wellesley Income Fund. And so you can just use this as a guide to create your allocation page. Morgan, if you want to go to the next one, I'll go through the investments a little bit more detail. These next two pages, these are the next two Morningstar reports are actual funds that are being added to the fund lineup and replacing other ones. And so these are the Morningstar reports for them. If you want to roll through these two, go to the performance chart. I'll be able to describe it a little better. Okay. So as far as the choices of the things that are being changed, one, the First Eagle Overseas is being replaced by the Vanguard Developed Markets Index. And then the PIMCO Total Return Fund is being replaced by the Dodge & Cox Income Fund. And so beside each one of them in parentheses, we have what's being replaced, and you can see the performance numbers down below for that. As I said previously, you will get a notice from BPA regarding that change and when it will take effect. But my guess is it's not going to happen until sometime in mid-December at this point. And if you're already invested in those funds and that's your allocation, it'll automatically switch over to the new one. So there won't be anything that you have to do. But if for some reason you do not want to continue in that fund, in the new fund, you will have to make a change in your allocation to prevent it from happening. Otherwise, it'll happen automatically. So if you're in the First Eagle Overseas and you're okay with it going to the Vanguard Developed Markets, it'll happen automatically. If you want to then switch out of First Eagle Overseas, go to something different, well, that's something you'd have to manually do. It's not going to be automatic. Okay. And the reason for the fund changes are, one, the performance has kind of lacked their peers, and you can see that through the performance numbers. Not so much the 12-month, that's not the most important thing to us. The 3 and 5 year tend to be, because it has more of a cycle, of an economic cycle in it. If they've underperformed for that long, we probably should make a change. And also, if we can find something that is higher rated and has lower expenses, then we always kind of want to make that change. And that's the case with these two. And so when we look through them, these seem to be choices that were pretty clear and obvious to do. And Sam and John agreed. And so that's why we're starting the process of switching those out. Okay, so just describing this, the fund names, these are all the funds available in the plan right now. It's on the first column. The second column is the category, whether it's large cap, growth, or value. Value tends to be, whether it's mid cap, small cap, whatever, value tends to be slower growing industries that have usually a dividend, and or they're more stable industries. Growth is tied more to like biotech and technology. And so those companies are growing much faster than average. And so that's what growth means. And if it's a blend, that means it's an index that includes both value and growth together. So that's what a blend index is. Ticker symbol is the next column, and then the current price, and then the performance through the 3-month, 12-month, 3-year, 5-year, and what the expense ratio is. Obviously, you can see this chart, and it's very stark right now, in that the equities have way outperformed the fixed income choices. So you can see the 12-month returns, the equity funds have done hands down better than the bond funds or the stable value fund. The stable value fund yields about 2%. It's guaranteed. We consider it like cash, but you can't really get cash if you go to the bank or you buy a short CD or whatever. It's not earning anything close to 2%. Okay, so this is actually a good choice if you're close to retirement or you want a really stable piece in your allocation. That stable value fund works very well. The 2 bond funds that are there, one is inflation protected, which has done really well this year because we've seen quite a bit of inflation. The other fund has not done as well this year, and it's kind of average with a lot of the other ones because the aggregate bond index has actually got a negative return year to date. And so those are intermediate term. And that's the reason why is that interest rates have moved higher due to the inflationary pressures that we're seeing with it. And then the ones below there, the international has not done as well as domestic. And that has been the case like 5 of the last 6 years. But the international markets are more cheaply valued than what the domestic markets are. So there are some folks saying that they're going to pick up and they're going to do better going forward. I don't know if that's the case or not. A diversified portfolio should have a little bit of everything in it because at different times things outperform. Obviously, in a down market, the stable value fund and the bond funds will do better than the equities. It's just that we've gone through this period of about the last 15, 16 months where the equities have just done dramatically much better than the bonds and cash. Now, that will not always be the case. And there are times when I've come out to Church's Cars and done the meetings where the equities have underperformed dramatically. They're down because we do have corrections and bear markets from time to time. But over time, as long as you can ride through the down periods, equities will almost always give you a better return. And a diversified portfolio of equities will definitely give you a better return than the fixed income. And you can just see that through the 5-year charts as well. Okay. The reason why I think the equities have done so well is the Fed keeping interest rates near zero kind of kickstarted the housing market. It got banks lending funds. People were at home not spending anything, and so when the economy kind of reopened through the pandemic, there's been a lot of pent-up demand, and that's pushed things higher. So equities have really performed well in that environment. Going forward, that's not going to always be the case. The Fed is actually meeting tomorrow, and they're going to probably start pulling back their bond buying program called quantitative easing. It's going to happen either this month or start next month. And they've said that once they stop buying, they're going to reduce it month by month until they kind of wean themselves off of it. And then they're going to probably look to raise interest rates sometime in the middle of next year or the second half of next year. And that will start to bring interest rates back up. That I would expect would bring the equity returns down. I'm not saying they have to go down dramatically, but there's going to be more of a headwind than what there's been. There's been a huge tailwind with a lot of the equities. But I think that's going to change. And then there's always other things to worry about, like energy prices going higher, the budget ceiling in which the Congress has kind of kicked the can down into December. There's always a potential geopolitical issue with China or Russia. And so there's always things to kind of worry about. But for the 401k, you basically want to get it in there, the funds in there, invested, and then rebalance it to that allocation. And then let it sit and let it work, let the returns work for you. And the reason why is initially when I talked about doubling of funds every 10 years or so, if you get a 7% return, your funds will double every 10 years. The thing is that if you're in a stable value fund, and it's earning 2%, that's going to take an awful long time for that to double. It's going to take like 30 years for that to double. So if you're young, unless if you're really risk averse, you should not have all your funds in stable value fund, which is the other goal I wanted to go back to regarding rebalancing. So if you're just starting out and that's where your funds are kept, you probably should have a little riskier allocation, unless you have a lot of stock outside and you're okay with being very conservative here. Or if you just don't want your account balance ever to go down and you never want to lose a penny, well, that's the only option that will give you that choice. But conversely, if you're closer to retirement and you're retiring in the next year or 6 months, you should probably have a big chunk of your allocation in the stable value fund or or the bonds, right? Because you don't want it to be going down as you're going to retire and starting to live off the funds. So it all depends on your situation and what your overall allocation looks like with your whole household, not just you as an individual. If you're married and have a spouse, does anybody have any questions on the performance or the fund changes or anything that we talked about to date? We're pretty much done with the presentation. This is the last page. And so we're just going to kind of open it up for questions that anybody might have. You'll have to unmute yourself, though, for us to be able to hear you.
I guess the silence speaks to no questions.
It means it was a good presentation.
Yeah, that was very good and very informative. So Jim and Morgan, we thank you. And again, like to
And
point
you guys
out,
are available to take a phone call from one of our staff members at some point in the future, right?
Correct. You can call us. You can email us. We've been more than happy to answer any questions you have.
Thank you.
All right, Sam. Well, if you want to stop the recording, we can